Welcome to Talk Tickers, where we break down the latest earnings calls. Today, we're digging into Graham Corporation's fiscal second quarter 2026 results. And this was a really interesting one, a classic good news, bad news story with huge growth on one side and some pretty serious questions about profits on the other. All right, let's jump right in with the headline number. Wow, Graham came out swinging with a massive 23% jump in sales year over year. That didn't just beat Wall Street's expectations, it blew them out of the water. On the surface, that looks absolutely fantastic. So you'd think the stock would pop, right? Well, not so fast. The market kind of shrugged. And here's why. A 220 basis point drop in gross margin? Oof. That's the number that caught everyone's attention and really got investors scratching their heads. All right, so let's dig in. We're going to unpack these numbers and see what's really going on with this push and pull between huge growth and shrinking profits. Okay, so check out this table. It tells the story perfectly. You see that monster revenue number, $66 million, way ahead of the $58 million expected. But then you look at adjusted earnings per share, flat, totally flat from last year. All that extra revenue and it just didn't translate to the bottom line. That's what we call a lack of leverage. And this is the engine behind that growth. I mean, look at this, a record-breaking $500 million backlog. That's incredible. And get this, 85% of it is locked in with long-term defense programs. For a company like Graham, that kind of visibility, knowing where your business is coming from for years, that's pure gold. Okay, let's get right into the heart of the matter. This is that core conflict I was talking about, the thing that makes this quarter so tricky to figure out. This chart says it all, doesn't it? On one side, you've got that beautiful 23% revenue growth. Awesome. But right next to it, adjusted EBITDA margins took a 100 basis point hit. That's the battle right there. The market is looking at this and trying to figure out which one of these bars tells the real story. So yeah, it leads to the big question everyone was asking on the earnings call. Where did all the profit go? Why didn't that huge revenue beat translate into better earnings? And management had an answer ready. The CFO, Chris Thurn, basically said it came down to sales mix. A huge chunk of what they sold this quarter was what you'd call pass-through revenue. Think of it like this. They had to buy a ton of materials for a big project. They build a client for it, and they book it as revenue. The problem? There's almost zero profit margin on that stuff. So it juices the top line, but really hurts the overall profitability percentage. They said this one thing accounted for most of the drop. Okay, so with that explanation in our back pocket, let's look forward. What's the plan? What did they say about the road ahead? And this is super important. After that massive beat in Q2, what did they do with their full-year guidance? They didn't raise it, they just reaffirmed it. That's a huge signal to the market. It's basically management telling us, hey, don't get too excited. That big quarter was mostly because some projects finished early. It's not like the whole business is suddenly accelerating into overdrive. Now, the good news is they're not just sitting back and letting margins get squeezed. They have a plan. They're spending money to fix this. They bought a company called Xdot for some high-tech, high-margin IP. They're pouring cash into automation, and they're targeting a really solid 20+% return on that. And of course, they're building out new facilities to actually work through that giant backlog. So where does that leave us? What's our take on the stock from here? Let's get into it. Look, the whole story really boils down to two competing ideas. The bulls will tell you, look at that $500 million backlog. It's an ironclad pipeline of business in booming sectors like defense. But the bears are going to come back and say, yeah, but what if these margin problems aren't temporary? What if they can't actually make good money on all that work? And that's the whole ballgame right there. So for us, we're calling this one market perform. The story is good, don't get me wrong. That backlog is fantastic, but it feels like it's already baked into the stock price. The market is basically in show me mode right now. We need to see real, actual proof that margins are getting better before investors are going to be willing to pay more for this stock. All right, if you're looking for something a bit more adventurous, here's a wild but plausible trade idea for you. A pairs trade. You go long on Graham to bet on their specific defense-driven growth story. At the same time, you short a general industrial ETF. Think something like XLI. The idea is to hedge out all the sector-wide noise, inflation, supply chain headaches, and isolate what you think is Graham's unique ability to outperform the rest of the pack. Okay, let's bring it all home. What's the final takeaway here? When you strip everything else away, it all comes down to this one simple question. We know the growth is there, we know the backlog is massive, but can they actually turn all that work into real, high-margin profit? Can all these investments in tech and automation pay off? That is the question, and that's exactly what we'll be watching for.
This is not financial advice.